Good morning, everybody. This is Marty Rosendale. I'm the CEO of the Maryland Technology Council, and you've tuned into the Capital M podcast live on video. The Capital M podcast is a podcast that's been developed to address the capital markets in Maryland, and the Maryland Technology Council is the industry association for the technology and life science companies throughout the state. The purpose of the Capital M podcast is to further the regional conversation around capital markets, define issues, and identify solutions with respect to access to capital and the capital markets. Now, our focus these days is on the impact of COVID-19 and the recession that has come about because of the pandemic. My guests today are Mike Buher, Brenan, Redman, and Nick Chavis from the Clearview Group. Mike is the director of the Assurance and Advisory Services practice. He also happens to be an officer on the board of the Maryland Technology Council. Brenan is the director of the Accounting and Finance Services practice, and Nick is the director of business development for Clearview. Gentlemen, welcome to the podcast this morning.
Thanks for having us.
Thank you.
Thanks, Marty. And I'll just start off just to talk a little bit about Clearview for those that may not know as much about us. We are a full-service consulting and CPA firm. As you mentioned, I lead the assurance practice, the traditional CPA type practice, and have also been part of our COVID-19 response team and generating resources to reach out to our clients and the community to assist through these very troubling times. And we've been helping with different federal and state programs and also just coaching, just general financial operational coaching. And joining me, as you mentioned, is Nick Chavis, one of our partners who leads our business development group, and then Brenan Redman, a director who leads our accounting and finance group. So Nick and Brenan, I'll let you introduce yourselves.
Yeah, I'm Nick Chavis. I've been with Clearview for 6 years now. I run the marketing division within Clearview, and I have oversight with another partner, Rich Compton, to support our sales and marketing efforts. Brenan, I'll pass it along to you.
Thanks, Nick. Good morning. My name is Brenan Redman. I run the accounting and finance services group at Clearview, a group focused around helping companies with staff augmentation, CFO advisory services, technical accounting support, systems migrations, process workflow reviews, etc. In addition to our group at Clearview on the consulting side, we also have service lines that assist companies with risk assessments, cyber and IT security, state and local tax consulting, and HR consulting, as well as managed services on the IT front.
Great. Gentlemen, thank you for your time this morning. I really appreciate it. So this morning we want to talk about a number of things with respect to business continuity and the challenges that everyone is facing. With respect to the stimulus packages, the last couple of days I've heard a couple of things. I read yesterday that the PPP, the Paycheck Protection Program, has already approved loans in the amount of about $250 billion, which is a big chunk of the $349 billion that was assigned to the program. I also read this morning that the emergency injury disaster loan, because it's been so significantly oversubscribed, it looks like they're only going to issue about $15,000 per loan because of that program. And I'm curious, what is your assessment of the status of the current state of these programs? But I just realized I forgot one thing about logistics when I was introducing the call this morning. For those people that are participating, Nick is going to address your questions through the chat. So if you have questions coming up, Nick is going to monitor the chat line, and he'll be addressing your questions. He'll also be able to provide you contact information if you have questions. And then at the end of the call this morning, we're going to have a Q&A. You'll be able to raise your hand and ask your questions directly at that time. So gentlemen, coming back to the status, what do you see as the current status of the federal and the state COVID relief programs right now?
Well, Marty, I can tell you, first of all, from the state perspective, those were oversubscribed within days. So I think the state programs are more or less shut down in terms of accepting new applicants. As far as the federal go, the Families First, that's really geared more toward providing paid sick leave and expansion of the Family Medical Leave Act. You mentioned the Paycheck Protection Program. We don't need to get into the details there. You did a great podcast last week on that. But that, as you mentioned, that is pretty well oversubscribed. The money's starting to flow. I did talk to a banker last night, and his comment to me was what I'm hearing from other bankers. They're about a half a step ahead of us, and they're about a half a step behind the Fed and the SBA. They're trying to figure it out because speed was really the key here. So if you did apply to the PPP, continue to follow up with your banker. There are some banks that are still accepting applications, but we do know a lot of them have just said they're done. They can't process what they already have. The good news is that the SBA is going to go back for round 2. They're trying to come up with a round 2 on the PPP, which is yet to get approval. At the same time, the Fed came out with its Main Street lending program, and that will do some overlap with the PPP. Keep in mind that was for up to 500 employees type companies and not nonprofits. The Main Street lending program, that's up to 10,000 employees and up to $2.5 billion in revenue. That's not necessarily a forgivable loan, but it's a fairly low interest rate, and there's some deferred principal and interest. So that is that's coming. It's just not been it hasn't been rolled out just yet. They announced it.
Right. Thanks, Mike. So I'm going to take a minute. I want to bring up a slide on my screen here. This is a report that McKinsey put out just recently. And I think they do a really good job describing the steps of recovery out of the COVID-19 pandemic. Now, they divided it into 5 steps. The first they call resolve, and I think for the most part we're there or beyond that. This is the first step where you need to take care of your employees. You need to make sure your customers are cared for, your business partners. If you're going to be teleworking, you need to make sure you've got all the systems in place. So I think we're pretty much there. The second step is resilience, and in my opinion, right now we're kind of in between the resilience and return phase of this chart. Return is all about creating a detailed plan for the recovery. How are you going to optimize your recovery coming out of this? But resilience is about cash management. It's about the challenges that our businesses are facing right now at this moment, and how do they make sure that they've got that resilience. So I just wanted to use this chart to introduce the topic of cash management and let you talk to us for a little bit about how do we optimize cash management. What should companies be doing right now with respect to this?
Yeah, Marty, certainly working capital and cash management are two buzz terms these days that are getting much focus, and rightfully so. AR and AP are going to be 2 of your most liquid, obviously current assets and current liabilities, and this is the time to really begin to scrutinize those down to the minutia. Thorough review of your days outstanding on your receivables, as well as your payables. Obviously, we want to look into ways to accelerate our collections and delay payments, ensuring we have a solid, strong cash position to handle day-to-day operations, payroll, and just keeping the lights on. Obviously on the customer side, we want to increase the cadence in which we're communicating with our customers. We want to increase the frequency of touch points. We want to communicate with them. We want to understand, what struggles they're having, what's bothering them on a day-to-day basis. How can we help them? Bringing in additional personnel to help with those communications. This is a stressful time, and really having a good finger on the pulse of what your inflows look like is going to be super critical. And so having that good process and process owners within your company to be able to speak to certain issues and know about issues with your customers almost before they actually come up, and having those good relationships. On the vendor side, obviously it's about communication. It's about, especially with your key vendors, we want to, to the extent possible, potentially minimize our frequency of deliveries if it's products. Why do we need a large warehouse of goods if potentially they're not going to move? So maybe we want to take a look at inventory levels, and the cadence at which vendors are delivering to us. But additionally, it all comes back to communication, right? It's about demonstrating to them that you're doing the best you can, demonstrating that you have a plan, and just keeping those lines of communication open. We're all in this together, so I think that's what's most important. And then when you get to cash management, once you sort of have an understanding and a bearing, or a heading, I should say, with your inflows and outflows, it's about developing those weekly cash forecasts, those daily touch points with your banks and with your business owners, to make sure that they're aware of how your cash is trending based on new terms that you may have established with customers and vendors. And it's tracking that weekly, and then broadening that out to maybe a 13-week cash flow to allow you to look quarter to quarter to quarter on a rolling basis. And again, as you see those weeks, those ebbs and flows, beginning to understand where you may be short. Maybe you were expecting a large deposit on at the beginning of a week, and maybe it didn't come through. And so where is that going to put you at the end of the week or the next week if you've got a bi-weekly payroll and so forth? So at that point, you're going to be able to understand, okay, where do we need to drive business decisions around maybe borrowings, maybe lines of credits if we have them. Begin to look at non-core expenditures, begin to cut back on those cost reductions. So again, understanding, driving communication with your customers, have a real good pulse on when you're going to see that cash. If they're experiencing struggles, how you're going to get through that. Maybe it's around installment payments, maybe it's around some deferred terms, et cetera. But at least you have the substantive background to begin to build out that narrative. And then around the vendors, it's, hey, how can we extend terms? How can we maybe do some installment payments? How can we shorten up our deliveries so we're not sitting on a bunch of inventory? And then building out those cash flow models. And then going to the banks if we have the credit lines established. If we don't have those discussions, it may be a difficult discussion, but it's worth at least exploring. Yeah, and then you just got to communicate. That's what it all comes down to.
Yeah.
So
Brenan, you mentioned vendors. In the situation that we're all facing today, what role does the supply chain play? What, with respect to business resilience, what should CEOs, entrepreneurs, businesses be thinking about with respect to their supply chain? I know there's a pre-emergency planning process that companies should go through, but when you're in the emergency, what should they be doing?
Yeah, I think it's really, first step is evaluating, what are your core expenditures? What do you need to, again, continue to operate, maybe at a reduced level, but continue to operate, continue to interact with your customers. What's going to drive that? Drive your sales. What can you potentially, look at, within your cost structure and begin to either pull back on entirely or at least somewhat. And then when you're dealing with your supply chain, especially your mission critical vendors, again, going back to that plan, that communication, and that cash flow, it's like, you're looking at them and you're looking for potentially, again, more favorable terms. You're looking at, hey, can we pull back on some of our deliveries instead of, dropping off 5 pallets of widgets? Can we go to maybe a just-in-time model, right? Can we go to, hey, let's not get a delivery every 2 weeks. Let's get a delivery every week, and it's half the amount, so that we're shortening our window, right? Our throughput window. And because we're going to be evaluating that on a more and more frequent basis. So again, it's demonstrating to your vendors and your supply chain that, hey, we've thought about this, right? We've gone through our plans. We've taken mitigation steps. We're not trying to take advantage of a vendor in favorable terms just for the sake of doing that. It's here's our here's the steps we've taken. Here are contingency plans, potentially willing to offer, hey, let's give you a deposit, right? So, give us more favorable terms. We're going to give you a security deposit, and if we don't live up to those favorable terms, then you have some leverage. So again, it's got to be a bilateral discussion, because again, we're all in this together, and so showing that good faith through, again, constant communication and offering up something to get something back. So that's what I would suggest.
All right. So I noticed we've got a few additional attendees have come online. So just I want to remind everybody, if you have questions, please write them into the chat area, and Nick will process those questions for you in real time. So I want to come back to the supply chain, because our suppliers are having the same issues that we're having, right? And they're having the same struggles. So the clients that you're working with, and they're having these conversations with their suppliers, the participants in their supply chain, how have those conversations become contentious? Have they, what has that been like, in order to do that negotiation?
Yeah, I don't think they've been contentious. In some of the interactions that we've had, again, I think Baltimore's a small community. I understand our tentacles that go far beyond the Mid-Atlantic region, but it's actually, this is a global thing, and everybody's, from what I've seen, companies are willing to work with other companies, because at the end of the day, we all got to come out of this. And whether it's a vendor or a customer, we're all dependent upon each other. And especially when we're talking about critical vendors or critical customers, there has to be some working relationship there. So it's not, from what I've seen at least, it hasn't been contentious, especially when, again, you've got stakeholders and decision makers on one end putting together models, putting together narratives around why something has to be delayed. Absolutely mission critical, because again, we want to get out of this thing and be, as strong as possible, to hopefully, when the market's ready to expand again, be ready to go out there and get back to business as usual as quickly as possible. So, businesses don't want to see other businesses go under just for the sake of, pressing their feet to the fire in order to get paid. I mean, that's just not, in my mind, that's just not good business sense for the long run. So I haven't seen it be contentious in my experience in the last month or so.
Yeah,
Brenan, I would echo that. The CFOs that I talk to, my clients, are the same way. Whether it's a mid-Atlantic ecosystem or another region, we all have to live together, right? And on the other side of this, you don't want to come out having made an enemy through this process. It's that old adage, I'd rather get 80% of what I want than wave the flag and jump off the cliff. So I think we're all ready to work together.
Yeah, no, I absolutely agree with that. The reason I asked the question is because I've had a few conversations with some business owners, and they're reticent to have these conversations because they feel like they're going to be difficult, challenging conversations to have. But the fact of the matter is, what I'm seeing is the exact opposite. Everybody's collaborating. Everybody's working together. Everybody wants us and the entire country to come out of this in good shape. And so I'm not seeing these as difficult conversations, which is why I brought the question up.
Yeah.
So Mike, you mentioned, you talked about the banks a little bit. Now, of course, people they're talking to their banks now about the SBA loans and some of the stimulus packages and whatnot. But what else should they be talking with their banks about? The banks got to be a source of expertise that can be helping our businesses today.
Totally agree. And every bank I've talked to, and what Brenan alluded to, is communicate, communicate, communicate. Discuss forbearance if you need it on terms, covenants. At this point now, a lot of folks are saying we may have been okay on our calendar year-end covenants through 12/31/19, but we see in Q1 and Q2 we've got covenant issues, and so the banks are ready to work with you. So I would keep communicating that. When it comes to that, just your normal banking relationship, when it also comes to the PPP or the Main Street lending, whatever it is, every CFO I've talked to said it's a full-time job. Your full-time job for the next several weeks is to manage the banking relationship. And the banks want to work with you. So I would just treat it as a full-time job. Be flexible and be fast, because the rewards are going to the swift right now. The ones who are flexible and nimble, they're the ones who are getting service and getting money. And as I mentioned, the bankers we talk to, they're trying. They're overwhelmed. And they're trying to figure out the SBA programs too. So continue to work with them. The other things to think about communicating are any concentrations you have. We talked about supply chain and any issues there. If you have any asset impairments, think about talking to them about that. The audit requirements, getting those extended out. And one I'm starting to see in some of the accounting press gets to if you have collateralized loans, say around AR and inventory. Well, Brenan talked about AR and making sure that you're talking to your banks about, look, the collections may be slowing down. As far as inventory goes, what happens if you can't get to your warehouse? What happens if you can't do your normal cycle counting? You need to work through that. And the profession's coming up with all kinds of creative ideas, use of drones and cameras and things, and just-in-time types of inventory arrangements. But in the end, continue to communicate. That's what the banks want to hear.
Great. So when we were talking, when we were preparing for this call, one of the topics that came up was automated payment systems, automated payments. What's the value of that, and is it too late if a company hasn't already established that, or is that something that they should be considering at this stage?
Yeah, I think there's if within the context of the business it makes sense, there's absolutely value to automated payments. Obviously you have, with automated payments, you've got little to no float on receipt of funds. So you don't have the 1-2 day availability as you would typically see in a checking or a lockbox type of scenario. You've got benefit of float on the actual processing fees to the card vendor. So, all along throughout the month, you're receiving automated, ACHs or direct debits from your card processor, but you're not receiving the invoice until the end of the month. And so, you've got, on average, maybe 15, 20 days of float there, which is key. When you're talking automated payments, you're talking, little to no manual intervention, especially if you've got your card vendor tied in with your ERP system. So, you don't have to worry about getting copies of checks and postings and those types of things. If you've got all of those systemic situations set up on the back end, that can all be automated. So you've got the soft costs you could potentially save from an efficiency standpoint within your AR group. And then lastly, payment risk. Payment risk is low, especially in this day and age when, some companies on their check runs are maybe running it pretty pretty darn close to the felt, as you say, when they're cutting checks. So, if they haven't done a great job on their end forecasting with their check runs and their clearances, there's good possibility that a check you would have received in your lockbox may eventually come back as deemed insufficient funds. So on the credit card or automated payment side of things, that payment risk is low. Now, you obviously got some fraud considerations there, but I think by and large, that's still a risk you're probably willing to take.
Yeah.
And a couple of things to chime in on that, Brenan.
Yeah.
One, we're seeing an uptick in cybersecurity issues because I think a lot of the bad guys are starting to see, wow, you're going to have more companies going to automated type payments, and so the targeted phishing becomes more of an issue. So I would say, yes, absolutely, go this route, but be very careful and make sure your cybersecurity is locked down. The second thing I wanted to point out was, as I've talked to nonprofits, let me speak to the nonprofits a little bit here. There's a lot of trepidation around the giving and it's the normal recurring revenues they're getting. Those that have been online, whether it's churches, synagogues, nonprofits, those who have gone to online type giving in the past aren't seeing the dips just yet that we all expected. So a lot of the giving is holding in there. So I would say, yes, go get it and do your online and your automated payments sooner versus later. I think you'll find when we all come out of this that was a move you probably should have made a long time ago.
Yeah. Hey, gentlemen, I want to give you a chance to talk a little bit more about Clearview. Tell me, so at the next stage, if McKinsey is right, the next stage of this recovery is planning for that recovery so that you maximize your ability to come out of this in a good position. How is Clearview helping clients do that? So when someone comes to you, how are you helping companies prepare and plan for that recovery?
I can tell you that our firm is we come with those big four international firm backgrounds, but we deliver it regionally. So we have that experience. We've been there, done that. As I mentioned earlier, we've assembled this COVID-19 response team, and we can be nimble in terms of addressing specific needs around as you come out of it. Each company is going to be different. Like I like to say, when you've seen one, you've seen one. So having the experience we have, we're ready to help you through not just the tax implications, but the operational implications. As Nick mentioned earlier, our risk practice is one of the biggest in town, and coming with a lot of operational risk types of experience. Brenan, I don't know if you want to chime in.
Yeah, I mean, this is obviously a time for all companies, no matter the size or industry, to begin to look at cost-cutting measures from a profit, from a shareholder value standpoint, which we'll talk about a little bit later. And Clearview offers various service lines that can help facilitate that. Obviously, one of our service lines is our state and local tax group, right? They can help go in and look at property taxes and sales and use taxes and to do a review of a company's footprint and exposure, and begin to look and see where there are areas in which they may be over-assessed. And those can result in significant dollars if their tax assessments are fairly significant. So that's one of the areas. We also go in, and this is a great time to begin for customers and clients to look under the sheets at their processes and their procedures, to look at One of the things we deal with customers is around their telco exposure, telco expense. That is a very niche industry. Depending on the type of customer, the type of client, they can have some significant exposure there on the telco side, and ensuring that they're getting billed properly, they're getting based on their infrastructure, their pricing is adequate, contract compliance, those types of areas that we can offer a subject matter expert to come in and take a look at their exposure there, right? And to say, hey, are you is your vendor living up to the terms of the agreement? Are you paying what you should be paying? Are you using the right technology? So those are areas that Clearview is helping on the cost cutting side. And then obviously we're all about process improvement too. So, we understand that customers may not have the capacity or the expertise to tackle a lot of these areas. And so we offer up our services to come in and help backfill and help demonstrate our value in those types of projects.
Yeah.
So,
hey, Nick, Mike mentioned risk management.
Yeah.
And that kind of struck a chord with me, because is it too late? I mean, we're in the challenge now. Is it too late to be thinking about that?
No, I mean, to your point, we're in that resiliency phase, in that McKinsey kind of chart. So, right now are times to be thinking about, what we can do better to manage risk effectively. And a lot of the things that we're talking about right now, whether it's cash flow management, managing vendors, my opinion is, and this is something that we talked about yesterday with my team, this is going to instill practices in business that they should have been doing all along to manage things more efficiently and effectively. It's going to build processes on the fly to operate more resiliently, whether it's supply chain resiliency, whether it's technology resiliency. We're definitely seeing an evolution in technology resiliency across the board, because most organizations are working from home at this point. So you're building in those risk management practices kind of on the fly to just operate as a business. So, I think we're going through that process. If some of the more mature companies out there have more established business continuity programs where they're looking for and building resiliency and testing those things out. Some of the smaller businesses don't have that ability. They don't have the resources to throw at building a full-fledged business continuity plan. So I think it's making them a lot of these organizations, in my opinion, are going to be stronger on the backside of this, because it's creating that risk management mindset and focus in their business, and inherently creating those resiliencies across technology, HR, and accounting and finance, your back office operations, as well as your core operations. So that's kind of my perspective on it. You asked a question about, what are some of the things that we're doing at Clearview. I think Mike and Brenan brought up some really good points. I put it in two separate areas. One is our contingent fee services, where we're gearing those up to help companies come out of this process with some cost savings, whether it's tax savings, whether it's looking at, vendor management and how to kind of effectively manage your vendors and provide some savings on that side. The telecom expense audits, we do construction audit work. So we have some service offerings that are built in at Clearview to provide money back to businesses, which cash is king right now. So anything that we can do to service our clients where we're providing those services and bring money back into the business is really important going through this and coming out of this. On the other side, we do a lot of staff augmentation work, and unfortunately, it's the nature of today's environment. There's a lot of organizations that have to go through layoffs. Hospitality industry is getting killed right now. So, when they come out of this process and the businesses open back up, those organizations aren't, in my opinion, those organizations aren't going to be rearing to hire right back, because there's a lot of unknowns about this COVID-19. We don't have kind of the vaccine yet. We don't know when the vaccine is going to be in place. We don't know what, December, January, February is going to look like. So our staff augmentation services can be cost-effective means to organizations to fill gaps, to still operate according to their plan, but more so on a temporary basis until they're really comfortable to make those hires back, and until they're really comfortable that the economics make sense to hire. So those are really those are the two things I think we're designed to do pretty effectively to support organizations through the process and coming out of the process.
Great. So gentlemen, you're a CEO of a small to mid-sized business. The world just turned upside down, and you're holding on with all your might. How do you think about maximizing shareholder value in this environment, and what can you do?
Yeah, I think, Marty, I mean, one of the unintended consequences of this, of this crisis, and we've kind of all talked about it in one way or another, is it's really driving all aspects and all layers of the business within the hierarchy to begin to take a fine tooth comb and sharpening the pencil and magnifying glass and whatever whatever other cliches you want to use to really look at the entire organization, whether it's the work streams, the revenue streams, or whether it's back office, whether it's disaster recovery, business continuity, relationships, right? Customer, employee, vendor, insurance, landlords. I mean, the entire gamut. And I think one of the unintended consequences is, as you begin to, again, shorten that window, right? Businesses are typically looking, quarterly plans, yearly plans, 3-year plans, 5-year plans. But the more you begin to kind of narrow that focus and narrow that window, when you start looking at weekly and monthly and quarterly being maybe your largest window, you can really begin to, again, peel that onion and start to look at, hey, what are we really doing here, right? Why are we, looking at processes and driving efficiencies and driving the right behavior from your employees? And in times of crisis, people either they flee or they come together. And so this is a good opportunity for companies and CEOs and CFOs and C-suite executives to really drive that messaging. It's like, hey guys, we are, we might be knocked down, but we're not dead, right? We're gonna dig into these details as much as we can so that we can ensure survival on the other end. And so when you start looking at shareholder value, it's again really looking at, to the granular level, what's our cash flow? What's our, where can we start to drive those cost improvements, cost management, and really reinvesting in the business in some of those core areas. So, Nick mentioned some of the contingency fee type arrangements that Clearview can provide. And it's like, okay, let's save a company $100,000 on their property assessment, their property taxes. And let's take that $100,000 and let's reinvest it into maybe some human capital that in an area where we're weak. Or maybe it's, hey, you know what, this crisis really brought to light that our business continuity plan and our disaster recovery and our security measures were not up to par. So let's reinvest into that. And so again, it's keeping that sort of that circle of advisors. It's keeping that, those communications all throughout the chain, and really being able to drive cost-cutting measures and then reinvesting in the areas in your company that are going to make you more sound and solid on the other end.
I would also add to that, Brenan, it's not just what should we be doing differently, but I'm also hearing from CFOs that are saying, we were doing things beforehand and we're not doing them now and we don't miss them. And so there's lots of things that can fall by the wayside. And I think this is a good winnowing type of process, as painful as it is. On the other side, we're going to stop doing things that just don't add value.
Yep.
Yeah, I would agree with that. That's going to be an interesting outcome, and it's not just going to be businesses. I think people are learning to do with less. They're not out shopping. They're not out spending money. I think those things are going to change. They're going to change at the business level. They're going to change at the individual level as well.
For sure.
Yep.
Yep.
So, a question about taxes. What do you gentlemen expect the tax impact of the CARES Act to be?
We talked about the PPP and the loan forgiveness, and let's be honest, and that if you play by the rules, that's more of a grant because it's a forgiven loan than anything. The other issues that kind of didn't get the press that the PPP did are things like the employee retention credit, and that's a credit against unemployment taxes up to 50% of those qualified wages. Take advantage of that. As if you are retaining employees, that is key. There's also this payroll tax deferral. In essence, payroll taxes that are incurred this year from the signing of the act through the end of the year, you don't have to pay those until half of it next year and the other half in 2022. So take advantage of that. As Nick mentioned earlier, cash is king. And if you don't have to, if that money doesn't have to go out in terms of payroll taxes or tax payments, take advantage of that. There's some other relief in there that, like the NOL carrybacks. Now it can go back 5 years. There's certain alternative minimum tax credits that you get. I would encourage you to every business owner, talk to your tax advisor, call us. Our tax team, I think, is second to none. And we can walk you through that. There's a lot to take advantage of and lots of little hidden things in the act that once you start to peel it back, you realize there's some good savings here. So a lot to unpack.
So kind of around similar lines, I understand FASB has decided to provide limited deferrals for ASC 606 and 842. Now, obviously, this is a planned question because I don't have a clue what I just said. So, can you explain to a layman what that means and the impact of it?
I just want to go on record that the non-CPA on the podcast just used some code language, so I'm impressed. So, the two main statements that have caused a lot of consternation are 606, which gets to revenue recognition and changing how that goes. That is pretty well been adopted by everyone at this point. There are some limited circumstances that haven't been, primarily franchisors. And so there's been some deferral there, but the revenue recognition standard is more or less already been adopted. 842 gets to leases. And long story short, unless you have a short-term lease less than a year, that underlying asset comes on your balance sheet. And thankfully, the standard setters said the last thing we need right now is companies changing the way their balance sheet looks because of an accounting pronouncement. And we can debate the pros and cons and the merits of that statement. Long story short, at least they've said, let's defer. Now, it's not been approved yet, but I haven't heard anyone clamoring to oppose deferral. So absent that, which you're not going to have, it looks like the lease standard won't be adopted for private companies until 2022. So that's good news. We've been doing a lot of consulting, and primarily with public companies, but we've been doing a lot of consulting around this and helping companies address their leases. This gets very, very technical because there's this whole concept of embedded leases where you'd say, well, we had a service agreement, but included in that service agreement is some equipment that helps us deliver that service. That's a lease. And it gets so esoteric. And thank goodness we get some time to reassess that, because as we've mentioned before, cash is king.
Great, thank you. So gentlemen, I'm going to ask you to get your crystal ball out now for a minute. That McKinsey report that I shared that one slide from, actually elsewhere in the report, it identified 9 different ways that this recovery could take shape. But one of the popular optimistic projections is that the recovery is going to be just as steep as the decline has been. And I'm curious, you know, when you look at your crystal ball, what do you see coming? What are we going to face in the recovery, say, in the next 4 to 6 months?
Yeah, I would say CPAs aren't good fortune tellers or valuation analysts, but we're seeing that there will be a good recovery, but it's not going to be as steep as the decline. It's going to be more cautious. It's going to be a little bit more gradual. And because these recoveries are rarely the same, rarely at the same pace. The good news is the banks are well capitalized. This is not 2008. This is not where the banks were caught off guard and didn't have the capital. They're ready to go. Brenan, I don't know if you have, or Nick, if you have another comment.
Yeah, I'll just jump in. I mean, I think just common sense wise, I don't see how it can be as quick as the decline. You know, just through all levels of the organization and industry. You know, you talk about retrenching or reduction in forces. I mean, you're never going to get those skill sets back in the same amount of time in which you lost them. So, you know, if you're trying to scale and ramp up back to, you know, where you were day one, that's never going to happen. So that's an investment there that takes time, that takes nurturing. From an overall business sense, when you talk about, you know, this first wave of coronavirus, you know, there's always going to be trepidation about a second wave, right? You look back historically, you know, you go back to, you know, the Spanish flu and how there was 3 waves in the Spanish flu, you know, over the course of a year, I think, or thereabouts. So, you know, there's always going to, you know, when you have a constricted market, there's going to be some nervousness, some anxiety around, okay, we're seeing a lull, you know, right? Let's try to get back to some sort of semblance of normal, you know, what if something happens again, right? So just as quickly as it arrived, it could arrive again, potentially. So, you know, I think there's going to be this wait and see mentality, certainly throughout, you know, if somehow we come out of this in some semblance in the next, you know, 2-3 months, you know, 2020 is going to be very, very much a let's just kind of stay the course and hold, you know, status quo for a while. Now there's going to be some bullish organizations out there that are certainly going to, you know, tackle some opportunities as they see them, but I don't think a widespread, you know, growth phase as rapidly as the market declined is going to happen. I think you're going to see pockets of it, but by and large, I think it's going to be fairly static.
Yeah, and I would definitely agree with that. You look at the market's reaction in that 2 week to 1 month period to what happened, and the market tanked over 30% in that short time frame. So there's the return to and recovery of this market is going to take much, much, much longer than that for certain. I also believe that it inherently made companies operate more resiliently, really kind of increase their procedures around cash flow management, and just incorporate procedures to operate more effectively in a challenging environment. And if they apply those procedures going forward and those processes going forward, it's going to make them better. That's kind of my take on it. So, but it's definitely not, all right, once we go back to business a month after that, everything's hunky dory. It's a 12 to 24 month process to get back to where we are, to get people back to the comfort of, operating in a standard environment.
Yeah.
Yeah, and I would also point out, Nick, to that point, it's somewhat regional too. There's some issues where there are some states and some regions that are going to be able to go right back, but then there are others that may be more rolling, and it may be now you can go to groups of 10 and then groups of 50, and so it really depends on your locality.
So, gentlemen, we've covered a lot of ground. We're coming up to the top of the hour. Is there anything that we haven't talked about that you'd like to bring up this morning?
I think, the overall theme throughout just goes back to communication. It starts within the organization. So communication with your employees, communication with your customers. If you've got a social media presence, get out there, if you're B2C or whatever, get out there, continue to reaffirm your customers that, hey, you're still here, the lights are still on, you're still working, you're still trying to, going back to the topics, driving, shareholder value, customer satisfaction, et cetera. You see that a lot with some of the businesses around here, especially, hey, we're still here, we can deliver to you, those types of things. Communication with your vendors, communication with your banks, treating your core vendors like you would banks, demonstrating that you're continuing to work on sharpening that pencil and driving profits and driving cash flow so that you can satisfy your obligations in a timely fashion. Again, these are challenging times, they're stressful times. Again, one of the unintended consequences, going back to before, is it can continue to drive efficiencies and process improvements throughout the organization, and ultimately profits. Mm-hmm. So, continue doing that within your organization, and then utilizing your circle of advisors, right? Your bankers, your insurance agents, your insurance brokers, your CPAs, your tax accountants, your attorneys, utilizing all of those folks, right? Giving them a looking glass into your business as it is today, and talk about your concerns. Have those tough discussions that you mentioned earlier, Marty. Mm-hmm. Folks are willing to listen. So that's probably just an overarching theme, I think, that can be applied. No matter the industry, no matter the size of the company, it's just all about working together, because we're all in it together. We're all going to get out of it together. So, right.
That's right. As we mentioned earlier, on the other side of this, folks will remember, as Brenan said, the people that got through it together. So no one wants to make any enemies in the process. And on the other side of this, we're going to all remember the folks that pulled together. So communicate, be accessible, be nimble, and there's lots of lessons that we will learn and come out, and there are things we'll do differently, and there will be things that we thought added value, and it turns out they just don't.
Yeah, I agree. And I think coming out of this, the degree of collaboration that I'm seeing is going to result in just some amazing business partnerships coming out on the other side. So let's open it up to questions from the attendees this morning. So if you have a question, there should be an option to raise your hand, and if you click on that, then I will unmute you and allow you to ask a question. All right, looks like this question is from Robert Olshaw. Okay, Robert, I think you should be unmuted.
I guess I'm curious your thoughts for the non-essential businesses are obviously getting hit real hard right now. The essential businesses, and everything's geared to the non-essential business in a sense. Now, the essential businesses such as trade, subcontractors, distributors, and GC, I believe, I also don't have a crystal ball, but I believe will be hit pretty hard come the third and fourth quarter as backlog decreases. It seems everyone's trying to get that backlog done, but no one's really in a hurry to do new projects going forward. So I think you're going to see backlog drop substantially with not a lot of backlog being added. I guess I'm just wondering what your thoughts on that, or if any thoughts. I'm not really sure what I'm trying to say, but I think some companies are hurting now. Some companies are going to be hurting a lot more 6 months from now. There's going to be a serious dip in work available.
Yeah, Bob, this is Mike, and good to see you on here. You know, as far as that goes, you may be right. That's why what we're seeing in our clients and also in our firm as well, continuing to keep a foot on the gas when it comes to business development, because you're very right. There could be a cliff later if you're not careful. You know, you're working through this backlog now, but there could be this dip later, and you want to make sure that you've kept your biz dev going and continue to reach out not only to your, you know, we talked about supply chain and manufacturing, but also you know, to your customers. Nick, you're pretty close on biz dev. Any thoughts on that?
No, I definitely would agree that there's going to be some hesitancy to push forward projects as a result of this. So you know, expanding your customer relationship, your prospect relationships, continuing to build that backlog outside of your core customers is going to be mission critical through this and post this process. Brenan, you have any thoughts?
Yeah, I would, you know, just, you know, as your top line and as your revenue stream may begin to take a hit, I think it's probably a good time to, you know, take a look at your financial position, you know, to begin to you know, assess where there could be some you know, difficult decisions or difficult discussions to have, but opportunities for cost containment, to take a look at the, you know, the health of some of the assets that you possess, having discussions with your banks. You know, if this is obviously having a discussion around maybe a 6 month stay versus an 18-month stay are going to be very, very different. But beginning to have those discussions now with your lenders and build out a plan. It's like, hey, you know, I'm feeling pretty good right now with our backlog. I'm not going to feel as good on July 1st about what's still, you know, out there that we're working on. You know, what are my options if this thing lasts 6 months? What are my options if this thing lasts 12 months, 18 months, et cetera, right? And begin to have those, you know, admittedly difficult discussions, but to begin to create some alternatives, both around timing and dollars, and just have those frank discussions. That's what I would suggest. Start doing it now versus later.
Very good point.
Yeah. So, gentlemen, thank you for that, and Robert, thank you for the question. I know the companies number of companies I've been talking to are telling me that they're fine at the moment. Maybe it's because of the backlog. Maybe it's just they haven't experienced any significant challenge yet, but they see their pipeline drying up, and so they see challenges in the future. So that was an excellent question. So we've reached the top of the hour, and I don't see any other hands raised at the moment. So, gentlemen, I want to thank you for your time this morning, and all the attendees. Thank you for joining us. Brenan, Michael, Nick, I really appreciate your support. I appreciate your insights. Again, everyone, this is the Capital M podcast live on video, given how we're all conducting business these days. I appreciate your participation. If you're not familiar with the Maryland Tech Council, if you're not a member, you can find our website at mdtechcouncil.com and take a look. If you're not a member, we'd appreciate you considering becoming a member. So thank you very much.
Thank you.
Thank
for
you,
having
Marty.
us.
Thank you.